Hi friends, welcome to Amazon World. In this video, I'll be explaining how to do illustration number 22, 23 and 24. Let's read illustration number 22. So, there are four partners, Shukla, Grewal, Jain, Narang. So, there are four partners, Shukla, Grewal, Jain and Narang, and their profit sharing ratio was 4:3:2:1, and their balance sheet as on 31st March 2013 is as below. So in this balance sheet you will get to see goodwill in the asset side, and that is rupees 9,000. Okay, keep that in your mind. And also one more thing, here you can see profit and loss. Okay, so if profit and loss is appearing in the balance sheet and that owned in the asset side, that means it is loss. So this particular amount, that is 3,000, is actually loss. There is a mistake here. After goodwill, stock, then debtors would come. So 9,000, 2,000, this 11,000 is of debtors amount. Okay, now let's read the question further. Grewal is going to retire, and the amount due to him was paid privately by the other partners in their profit sharing ratio. So this is one of an important sentence here, because in this question we'll be not drawing Grewal's capital account due to this point, because they are paying just imagine or just think, Grewal is the person who is going to retire. So why do we actually prepare capital account for a retiring partner? We have to find that particular amount which the partnership firm have to give that person, right? Because he is going out from the business, so whatever amount is there to give him, that should be settled. So in order to find what is that amount or what is the value of that amount, only we are drawing the capital account. But since in this question they are telling that he is being paid privately, can we actually show that the amount is being paid privately? So we cannot show the amount, that is whatever after preparing Grewal's amount, we'll get the balancing figure, right? So that amount will be, we would either show like we have made immediate payment, just like writing to bank account, or we used to transfer that particular amount into loan account, right? But in this question they are paying it privately, so we cannot transfer whatever amount balancing figure we get into either of this accounts. So we cannot show Grewal's capital account here. So what are we going to do? There is one other thing we are going to do. We are going to acquire, since this existing partners is going to acquire, like they are going to pay Grewal privately. So what is happening is that since Grewal's account cannot be, capital account cannot be showed, it will be when we are preparing a capital account, we will show it like Grewal, since existing partners paid Grewal privately, his capital is being acquired by the existing partners. Like that is how, so that is how we are doing the calculation in this question. Okay, so let's read the question further. So once this existing partners make the payment to Grewal, what happened? Grewal's capital will be acquired by the partners in their profit sharing ratio. Fine. Next, Chakraborty. Oh my god. Was sorry, because like I'm new to these names. Chakraborty was then admitted as a new partner. Latter paid 5,000 as capital and 3,200 as his share of goodwill. So Chakraborty is bringing capital rupees 5,000. His goodwill premium is 3,200. Fine, and his profit sharing ratio, that is his profit, future profits, his share is of 1/5. Now Shukla, Jain and Narang resolved to share the remaining profits as 3:3:2. Okay, so what, after giving 1/5 of the portion, the rest is being shared by Shukla, Narang and Jain in this 3:3:2 ratio. Fine. So we have to actually find what is the new profit sharing ratio. This is not the new profit sharing ratio, but can called as a share. Okay, because here in this given profit sharing ratio, they have not included Chakraborty's. He is a new partner, so we have to actually include him also to call this as a new profit sharing ratio. So we have to first find what is a new profit sharing ratio. It was also decided that the capitals of Shukla, Jain, Narang and Chakraborty should be made proportionate to their new profit sharing ratio, and for this they should bring in or withdraw cash. So whenever a question says that the partners have to either bring in or have to withdraw cash, that means there is a concept of adjusted capital. Fine, as necessary. Now what we have to do, we have to pass necessary journal entries and also give effect to the above transaction. So the first thing, have given us two notes. Let's see. The undistributed loss should be shared by Shukla, Grewal, Jain and Narang, all partners in all ratio 4:3:2:1. So where is loss? Here in the asset side you will get to see the loss amount, that is 3,000. So the first thing they are showing is sharing the we have to what we have to do, they are telling us, they are reminding us to share this 3000 with the partners. So why? Because we have to share this 3000 with these partners. Why? Because this balance sheet was acquired, this balance sheet was prepared during the time of these 4 partners. So we have to, whatever loss or profit came, we have to share it with these partners itself. So that profit sharing ratio is, profit or loss sharing ratio is 4:3:2:1. So loss is here 3000, we have to share this 3000 to these 4 of them in this ratio, and that is what we are showing in the very first journal entry. There is some problem with the alignment. Okay, so Shukla's capital account debit 1200, then Grewal's capital account debit 900, Jain's capital account debit 600, Narang's capital account debit 300, to profit and loss account you get to see 3000. So this is the very first journal entry. We have shared the loss which was not distributed. Now we have already distributed the loss. Fine. Now what are they telling? Grewal retired and the amount due to him was paid privately by the other partners, Shukla, Jain, Narang, in their profit sharing ratio. So let me show you that, but before explaining, we have to do some calculations as well. So the very first thing, let me explain you the sacrifice or gaining ratio as well as the new profit sharing ratio. So they have already given us everything in the study mat itself, so I'm just following the study mat. Let's see here, new profit sharing ratio. So we all know Chakraborty's share is 1/5. It is already given in the question directly. So what we have to do, they have also given us 3:3:2. That is the profit sharing ratio of Shukla, Jain and Narang only. Only these 3 after the retirement and admission, Shukla, Jain and Narang's profit sharing ratio became 3:3:2. So we have to make all these together, right? Chakraborty's as well as have to be added with this. So how are we going to do? So we all know, we have already explained this calculation in the very beginning of this partnership account chapter, because the concept, when I was explaining the concept of this goodwill and new profit sharing ratio, I've already explained this, right? So we have to do what? We all know 1/5 is the portion of Chakraborty. So all together, all shares is equal to 1. Just imagine. So it's like 1 is equal to what? 100%. Just like how we take in percentage, 100%. When it comes to fraction, 1/1 is what we take, right? So 1, we took 1 minus 1/5. 1/5 is the profit sharing ratio of Chakraborty. So we took 1/5 from this one. So the balance is 4/5. Now they have told us 3:3:2 is the profit sharing ratio between Shukla, Jain and Narang after considering Chakraborty's profit sharing ratio, right? So we have already considered Chakraborty's profit sharing ratio. Let me call them what? Shukla, let's call Shukla as S, Grewal G, Jain J and Narang N, and also Chakraborty I am going to call him C. These names are too complicated for me. Okay, so we have given C's portion already 1/5. So after considering C's portion, the balance portion is 4/5. Now this 4/5 have to be shared with whom? S, J and N, right? So 3:3:2. So now let's just make all together. That is, we all know 4/5 is the remaining share. So 4/5, 3 by. So let's see what is Shukla's, what is S's share. 3/8 is S's share. So 4/5 is the share which is balance. So in 4/5, 3/8 of 4/5 share is of S's. Like that. 2/8 of 4/5 share is N's, and 3/8 of 4/5 share is of Jain's. That means J. Okay, so after doing this multiplication, we'll get to see the profit sharing ratio 3/10, 2/10, 3/10, and we all know 1/5 is the Chakraborty, so that is C's share. Even I am forgetting the short form I gave there. Okay, so 1/5 is the C's share. So we have to make the denominator same to this 10, right? So what we are going to do, we have to just multiply by 2. So 1/5 whole multiplied with 2. So 2/10 we'll get. So our denominator became same. So what will be our new profit sharing ratio? 3:2 So that is what we got. So we all know how new profit sharing came. So we have to see whether sacrifice or gain have happened, right? So for that, they have already shown it clearly here. It is very well written here in the box so that we could understand it easily. So let's see. All ratio we have already know. Grewal, that is G, have gone, retired, so there is no need to consider him. So 4:1. Then what else? New ratio is S, J and C, that is a new partner have also been included here. So all 4 of them came. So S, J and N, we have to only consider 4 2 and 1 because Grewal G have already retired, so there is no need to consider him. 4:2:1 is what we have to consider, and that is how this profit sharing ratio came. So old ratio minus new ratio will get what? If the answer is positive, that is sacrifice. If the answer is negative, that is gain. Okay, if we are going to do old ratio minus new ratio and the answer is positive, the answer is a sacrifice. If the answer is a negative one, then the answer is gain. Fine. So let's see. So when we subtracted 3/10 from 4/7, I got 19/70, which is a positive amount. That means S had sacrifice. Now when it comes to Jane, when I subtracted 3/10 from this 2/7, I got a negative 1/7D. Okay, that means what? Jane is having gain. When it comes to Narang, when I subtracted 2/10 from this 1/7, I got 4/70 negative. That is also gain. So these three are the very important people for us. So we all get to know there is only one person who is going to have sacrifice. So what is the concept that I have already taught you? That is, new partner is coming. C is being admitted to the partnership firm as a new partner. So already C would bring a portion of goodwill premium. Fine. But in here, this question, only S is having the sacrifice. So that means the existing partners J and N also have to bring a particular portion of goodwill premium to S, because S alone sacrificed, right? So we already get to know what is the gaining ratio here. 1/70 and 4/70 is the gain what Jane and Narang got. So in this ratio, what we are going to do? We are going to bring J is going to give Shukla as a particular portion of goodwill premium, and in this ratio 4/70, N is also going to bring a particular portion of goodwill premium to S. Okay, so that also we have to show in the capital account. Now we are going to come with the rest of the calculation. That is, we already get to know C's share is 1/5, right? So 3,200 is a goodwill premium which is bought by C, right? So we all know when we apply the profit sharing ratio of the newly admitted partner with the firm's full goodwill, will get what? That particular portion which that newly admitted partner have to bring. So we already know what is the amount that a newly admitted partner is going to bring, and that is 3,200, and we all know what is the profit sharing ratio, what is his share, right, of the what is his share of the future profits, and that is 1/5. So what we have to do in order to see what is a firm's goodwill's value, we are going to reverse the calculation. That is, firm's goodwill into 1/5, we will get 3,200. Since we don't know what is the amount of firm's goodwill here, what we are going to do? 3,200 into reverses into 5/1. That will get, when we do that, we'll get 16,000. So this is the goodwill of the firm. But when we get to see the asset side, we will see goodwill is of 9,000 only. But here when we see 16,000 is there. So why is it that? So there is two ways you can do this question. You can either follow the study mat, or you can either follow me. In the study mat, what they are going to do is they are going to write off this 9,000 entirely. So there will be no goodwill shown in the balance sheet. Like when we are going to prepare a new balance sheet, there will be no goodwill in there, because the only goodwill which has been shown on the books is 9,000, and we are going to write off that. But in my way, if I am going to do is that, what I am going to do is that I am going to raise the difference 7,000. That is 16,000 minus 9,000, 7,000 is there. So what I am going to do is I am going to raise the 7,000, and I will show the goodwill in the balance sheet. Okay, so that is the two different ways. You can either follow the study mat, that is also correct, or you can either follow me. Okay, any one method have to be followed. Fine. So if you are going to raise a goodwill, and this is the entry we are going to have. So here see, current goodwill is 3,200 into 5/1, we got 16,000. So raising goodwill means 16,000 minus 9,000. You will get what? Sorry for the no clearance. Okay, 16,000 minus 9,000, you'll get 7,000. I'm going to raise this 7,000. You can either write off the entire 9,000, so there will be no goodwill in the balance sheet, but you can also raise the difference amount. That is the current goodwill. Whatever goodwill is there shown in the balance sheet, you can either write it off completely, or you can raise it to the current goodwill. Fine. So 7,000 I am going to raise. So the goodwill, the journal entry for raising the goodwill will be goodwill account debit 7,000 to SS, to G's, to J's, and to N's capital account. Okay, so these are the old partners, including G. G is the one is going to retire. Including him, you have to raise, because this goodwill belongs to everyone. That the old partners, it belongs to everyone. So 7,000 to S's capital account, to G's capital account, to J's capital account, to N's capital account. In that ratio 4:2:1. So what happens here? 7,000, 2,800, 2,100, 1,400, and 700. Fine. Now we are going to come to the balance calculations. And the other thing I have told you is that we already got to know that J and N is going to have gain, so they have to bring some portion of goodwill premium to S, since S alone sacrificed, right? So C would bring, right? There is no need to specially tell C to bring goodwill premium. We have already bought 3,200 fine, so that we are going to show in as cash. Okay, but in case of J and N, they were both existing partners, and since they didn't sacrifice, what they are going to do is that they are going to bring a particular portion of goodwill premium to S. So in order to find that, we all know that 60,000 is the goodwill, and we get to see the gain, right? So we are going to find what is the amount J and what is the amount N is going to bring for S. So let's see, 60,000 into 1 by 70, 60,000 into 4 by 70, you'll get to see the amounts which is to be bought by J and N, and that have to be debited to their capital accounts. Jane's capital account debit to the 229, Naran's capital account debit to 914, cash account, this refers to the goodwill premium which is bought by new partner 3,200, and to Shukla, everything have to be credited to Shukla's capital account, that is 4,343. Okay, now we are going for the further calculations, that is nothing but preparing capital account. Fine. So even before preparing capital account, there are some things you have to make all right. So let's just first explain every journal entries. But in this question, there is a concept of adjusted capital, I have told you, right? So this adjusted capital would come, so that might become a bit confusing for you, but it's actually like what I have already taught you in the previous videos itself. There is no changes, it's just that I have drawn capital account in this way, so that this is a familiar way that you already prepared capital account, but this is the way which has been shown in our study mat. But actually in the questions which adjusted capital would come, it is better to draw capital account in this format only, but it's just that since you all are familiar with this capital account, I just thought to prepare this capital account itself. Fine. Okay, so before preparing capital account, you have to get to know certain journal entries, and after explaining them, we'll get to do this capital account. After preparing the capital account, we have to pass 2 more journal entries. Okay, so let's see what are those journal entries which you have to notice. And the first journal entry we have already explained here, that is sharing of the loss. And the next journal entry is about, we already told this, existing partners paid Grewal privately. So I have told you we cannot show Grewal's capital account, because they are why we are preparing retiring partners capital account, in order to find in order to find that amount which the partnership firm have to give him. But since in this question we cannot, whatever balancing figure we get, we'll transfer it either to loans account, or we'll show it like we have immediately paying, so we'll write to bank account, but we cannot show in either of them. So what we will do, we cannot transfer it to anywhere, because this amount is being paid privately, this amount is being paid privately. So what we are going to do is that we are going to say that this amount was paid privately to retiring partner. So retiring partner gave his capitals, his share, to the existing partner. So that is what the concept is going, that is how our study mat teaches us. Okay, let's see. So in this question, Grewal's capital in the beginning, that is when you get to see the balance sheet of the, when you see the balance sheet which has been provided in our question, you will see 6,500 is the capital of Grewal. So let's take that. Then what happened, we already raised the goodwill, and when we raised the goodwill, the portion which G got was 2,100, so we are taking that also. After that we are also share the loss, right? So when we share the loss, 900 was G's portion, so subtracting it will get to see 7,700. So this is the amount which have to be paid to Grewal by the existing partners. So this amount to be given to Grewal by existing partners, 7,700. Fine. So how our journal entry would appear? Journal entry will be Grewal's capital account debit 7,700 to S's capital, J's capital to N's capital in the ratio 4:2:1. Fine. So what happened? Now these amounts have to be shown in the capital accounts of these. That is, this 7,700 is now in the hands of S's, J's and N's. We paid, the partners paid, existing partners paid amount instead of this shares. Okay. So they acquired, S, J and N acquired this much shares. So we have to show this in the capital accounts also. So that is the second journal entry. The third journal entry is the amount that a capital is being bought by Chakraborty, right? So the cash account debit to C's capital account, that is 5,000, which has been bought in as capital. That 5,000 is already given us in the question directly. Then now let's prepare capital account. So When we are preparing the capital account, we have to prepare S, J, N and also the new partner C. So balance brought down 7,000, 5,000, 4,000. You will get these amounts from where? Balance sheet, which has been provided in the question. Next comes capital, which has been bought in by the new partner. We are writing it as by bank account 5,000. Now here comes Grewal's capital. We have already acquired, the existing partners already acquired the share or the capital of Grewal. Okay, since they have privately paid to him. So 4,400, 2,200, 1,100 have to be credited to the SGNN. Fine. So we are writing that also. Then comes what? Goodwill. We have already raised a goodwill, right? So 2,800, 1,400 and 700 have to be shown. There is no GS account here. So there is no need to show this 2,100. We have already settled that. 7,700 we got, and that we have already shared with the partners. Okay, now here 2,800, 1,400 and 700 only to be shown, the goodwill raised amount portion. Then comes what? C is already bringing 3,200 as goodwill premium. You can write it as goodwill premium also. So 3,200, since we are passing the journal entry as cash, we are writing it as cash itself. So 3,200 will be only S will get this amount, since S is the only one who is going to bond the loss. So we can say he is the only one who is sacrificing. So 3,200 will be alone given to S. And also, since J and N is going to have gain, even they have to bring some portion of goodwill premium to S. So that is what been shown here. We have already told about the calculation and we have already passed journal entry. So 229,940. So this amount have to be shown as taken from J's and N's account. So we have to debit them. So to S's capital account, 229,940 have to be also be shown in the debit side of J and N. Then what comes? We have already shared the losses, right? There is no G here, but the other losses we have to show here, 1,200, 600, 300, the losses being shared also being shown. So since this question we already know, there is a concept of adjusted capital. What we have to do, we don't know. There is a certain amount which S, J, and N have to bring or might withdraw. There are two concepts. We don't know how much money have to bring in and how much money have to be withdrawn from the capital account, because they are telling us to maintain the capitals in the new profit sharing ratio. So for that, let's just, till now we are preparing a half capital account. So we got what? Till the amount which we got with the amount we got till now, we are preparing a first half of the capital account. So that I prepare the capital account in this way so that you'll get to understand clearly about the adjusted capital account. So we got what? This as the totals. So till now we have prepared till here. Okay, so we got these as the totals, and when we looked for the balancing figure, we got 17,343, this one, this one and this one. So actually this is not the balancing, but this cannot be written as balance carried on. So that's why I have not written anything here. Since in this question there is a concept of adjusted capital, we cannot tell this as the balancing figure. Okay. That is the closing balance of the capitals. So what we are going to do, take all this 4 and add. So taking all this 4 and adding is what we call what? Adjusted, combined adjusted capital. Okay, so 34,700 is what we got. And now what we have to do, the new profit sharing ratio is what they are telling us to maintain the capital balances in the new profit sharing ratio. So 34,700 we got, and we have to maintain it in this ratio. So 3 is to 2 is to 2. So we are going to divide it in that way, and we get what? 10,410. 10,410, 6,940, 6,940. Fine. Okay. So when we did that, okay, now what we have to do, we have to ignore these things which I have written. You have to ignore this total here, you have to ignore this total here, and also you have to ignore the balancing figures I have brought here. Now there is only this portion. We have just from now onwards we are not going to consider this portion. Okay. So we have already got this one, and this will be the amount we'll write as balance carried on. So we wrote balance carried on, fine, but still there is such amounts which is like when we add both the sides, we'll get to see both the sides is not tally, they are not in balance. So when we do that, when we do S's account, we'll get to see there is certain balancing figure we get in the debit side, that is 6,933. What does this mean? S have excess of 6,933, he can withdraw this amount. 6,933 can be withdrawn by S because he have got excess amount in it. Fine. And when it comes to J's, N's and C's capital, we'll get to see this as the amount 2,639, 2,354 and 1,940. What have to do? What does this mean? That is J, N and C have to bring these amounts to the partnership firm. Only then it will be maintained in this new profit sharing ratio. So this is the amount which have to be withdrawn and also be bought in to the partnership firm. So we got that. Fine. Now we have to pass the journal entries for these amounts. So that is what I'm going to explain now. S is the only person who should withdraw the amount. So S is capital account debit to cash account, 6,933 have to be withdrawn by S. Then what else? These three have to bring money again. So cash account debit, the total of these three, and writing the amounts separately. The exact amount which we got here. Okay. So this is the two entries. After this, the question is over. So I think this question is easy for you. Now when we explain about the balance sheet, let's see. I've only written the amounts. Okay. Okay. So please don't copy this kind of balance sheet in your exam. Okay. You have to completely draw the box. You have to write everything. Just like how it's shown in our study mat. Okay. It's just that since I'm a bit lazy, I have not drawn it. Okay. So asset, what comes? 2,000. 2,000 is of stocks amount, 11,000 is of debtors. Cash, how cash would come? 5,000, already cash was there. Then in the question, the balance sheet which is provided in the question, you will get to see 5,000 already, and plus 5,000 which is bought in by new partners capital, plus 3,200 which is bought in as goodwill premium of the new partner, plus what? Plus all together, add this all together, you'll get 6,933. So plus 6,933 minus again 6,933, because this amount is being withdrawn by S, right? So from the firm, this amount is going to get withdrawn. So minus 6,933. That is once again 5,000 plus 3,200 plus 6,933 minus 6,933. You will get 13,200. Then what we have to show? We have to show the goodwill, that is 16,000. At the asset side, you will get 42,200. When it comes to liability side, write these amounts as the capitals. When we add these all four, you will get 34,700, right? Add that, and sundry creditors is already there in the question. There is no change for that, so write it as it is, 7,500. When we add these together, we'll get 42,200. Thus both sides are tallied, that is balance sheet is tallied. So this is how we do illustration number 22. I think this is clear for you. Now let's explain how to do illustration number 23. Now I am going to explain illustration number 23. XYZ are the partners here, and their profit sharing ratio was 3:2. Okay, and their balance sheet as on 1st January 2030 is as follows. So they have given us their balance sheet. Now let's read the additional information. X retired on 1st January 2013. Okay, so the same date on which this balance sheet have given us, on which date R is admitted as new partner. So in the same date itself, R became a new partner. And for the purpose of adjusting the rights between non-partners, goodwill to be valued at 84,000. Yeah. So goodwill is there, and it should be valued at rupees 84,000. Sundry debtors, stock. Sundry debtors is going to be reduced to by 16,000. Here sundry debtors is of 96,000. When it get reduced by 16,000, it becomes 80,000, right? So in this question, they are not asking us to prepare a balance sheet. So if there was a balance sheet, we could have write this 80,000 in that balance sheet, but now in this question they are not asking us to do that. So we have to write this 16,000 in the revaluation account, and here stock is going to be reduced to 1 lakh. So you have to see the difference here, buy and to have different meanings. So here what it means is that for here stock is 1,12,000, and they are saying it is being now reduced to 1 lakh. That means the difference is 12,000, and that 12,000 have to be written inside the revaluation account. Now X is to receive 44,000 in cash on the date of retirement, and the balance due to him have to be paid as loan at 8% per annum. Repayment of loan to be made at the end of each year. Okay, so 44,000 have to be given him in cash, okay, immediately, and the rest, the balance have to be paid to him in loan wise, that is at 8% per annum. Okay, so this is the interest rate. Now they are telling us that repayment of loan to be made at the end of each year. Okay, so this X is going to retire on this 1st January 2013. So on 31st December 2013 will be the first payment. Okay, by annual installments representing 25% of the future profit before charging interest on loan. Okay, so I'll explain what it actually means, but there is still a confusion for me there. Okay, let us read further. R is going to bring 1 lakh rupees as his capital, and they are not saying anything about the goodwill premium. Okay, they are saying nothing about goodwill premium. Then the new partners are to share profits and losses equally after paying the interest on excess loan. New partners are to share profits. Okay, their new profit sharing is going to be 1:1:1, and their old profit sharing is 3:2:2. So if you're going, you can try finding sacrifice ratio or gaining ratio. So in this question, there is one point regarding that. So everyone, please do the sacrifice ratio or gaining ratio calculation with the ratios which they have provided us. Okay, there is one point I have to like to convey. Then what else? The net profit for the year ended 31st December 2013 is 64,000 before taking into account the installment payable to X. Sorry if there is any voice disturbance. So they have given us 64,000. They have told us that 64,000 is the profit of this 31st December 2013. So there is no mistake in this date. It is 31st December 2013 itself. So my mistake was I didn't consider this date. I thought it was a mistake from their hand, but it is actually not a mistake. The date is not mistake. Okay, so 64,000 is a future profit they are telling here. Okay, because when we see like this is happening on the 1st January 2013, they are telling us that you have to do in this way on 1st January 2013. So future profit will be 64,000, which they are telling that they are going to most probably going to get the 64,000 in 31st December 2030. So when we are when we take the viewpoint that if we are going to, today is 1st January 2013, then the 31st December 2013 is like a future, right? The 64,000 is actually a future profit for them. Fine. So in the year ended, they are telling this 31st December 2013, 64,000 is the profit. So that is we are going to take as future profit. Now they are asking us to prepare profit and loss appropriation account for the year ended 31st December 2013. You have to make it 2013. Okay. Even in 2022 syllabus, they have made the same mistakes. I think they are just copy paste here. You will get to see, and in this portion they have accidentally forgot to alter this one. 31st December 2013 exactly will be there in 2022 syllabus. Okay, so you have to correct that. So 31st December 2013 have to be written here. Then comes capital accounts. Okay, then X's loan account as on 31st December 2013. So now let's just prepare the revaluation account first. So I have told you first to try finding the sacrifice or gaining ratio with this ratio, and also they have told us that they are going to share in equal basis, right? Equally. So we have to 1:1:1 will be the sharing ratio. So try finding the gaining or sacrifice ratio. Okay, there is a point I like to convey. That's why. Then here, the first thing we are going to do is preparing a revaluation account. So so that I return the date so that you don't get confused. Assuming this revaluation account is being prepared on 1st January 2030. So here they have told us this 84,000 is going to be valued, right? Have to be raised. In this, you'll get to see there is no goodwill here. So first we have to do what? We have to raise this 84,000, right? So we are raising it through revaluation account. So that's why goodwill is going to appear here. Fine. Then comes what they have told us that sundry debtors is going to be reduced by 16,000. So take that difference 60,000 here and write it directly. Then comes what they have told us, the stock is going to be reduced to 1 lakh. That means the difference is 1,12,000 minus 1,12,000 is the difference. That 12,000 have to be written inside the revaluation account, and that's what they have done here. Then after totaling both the side, you will get the debit side is the greater one. That is, it has balancing figure appears on the debit side. So that is a profit, revaluation profit, and that have to be shared among the all partners, that is XYZ, in their profit sharing ratio, that is 3:2:2. So that is what they have written here. So take this profits to the capital account. So please remember, this is not the capital account which the question have asked us to do. This is the capital account which we are preparing on 1st January 2013, and in the question they have asked to prepare a capital account on 31st December 2013. Okay, so this capital account have to be prepared in order to get the balances of the existing partners. So that's why we're preparing this capital account. Fine. So we are writing down the opening balances which we'll get from the balance sheet which is provided in the question. So write it as it is. Then comes the revaluation profit which we got from the revaluation account. Write it down. Then we are telling on the date of retirement, we are immediately paying him 44,000, right? So that have to be shown on the credit side under excess account. Then total both the sides, and you will get Y's and Z's capital here, closing balances here. We have some use with this 96,000 and 86,000. Keep it as it is. Then we are going to come to the balancing figure of X. What we are going to do? We are going to write it as X's loan account, because it is already told that 44,000, after paying 44,000, whatever amount is coming as balance have to be transferred to loan account, and 8% interest rate have to be claimed on this, right? Yeah, per annum. Fine. So this is how we prepare the capital account as on 1st January 2013. So why we are preparing is this: we have to get first what is the amount which what is the amount the partnership firm has to transfer to loan account, and also have to get Y's and Z's closing balances as on that date. Okay. Then what we are going to do is that we are going to prepare X's loan account directly. Okay, so X's loan account, we have already got the 80,000. Please change the date here. Okay, so X's capital account 80,000 you have to write here directly. Then comes what? Then it became 31st December 2013. You have to write the date here. They have not written date here. Then what happens after, at the end of 1 year, what happens? Interest will accrue. So interest will be 80,000 into 8%, that is 6,400. Okay. So I have come up with two possibilities in the when we are preparing the loan account. As like you have already wrote, interest is going to acquire at the end of the year, right? End of the first year, 6,400 came here, and here they are writing the amount which we are going to pay. They are saying, so annual installments they have told. When you see the question, they have told us annual installments. Yeah, annual installment. So installment means that includes both principal and interest amounts. So most probably my first possibility is what is going to happen, because they have only written 60,000 there. Usually we used to write both principal and interest amount. So I think they are going to consider it like this. Including both, it becomes 60,000. That means 25% of 64,000. We already know what is 6,400. We already know that interest amount is 6,400, and we also know that it is 16,000 which they are going to pay. That is 25% of profits. Most probably the 6,000, the 60,000 includes 6,400. The other possibility is that we have to write 60,000. It was a mistake from the study math side. We have to write both 16,000 plus 6,400 where in this area. So most probably my first possibility is what they are considering, I think so. So this 60,000 includes both interest and principal amount. So in principal amount will be what? 9,600. Okay, so that is not a concern actually. So 70,400 will be what will get us balance carry down, that is a closing balance, if you are going to consider as the first possibility. Or if you are going to consider this one, then our closing balance will become 64,000. Yeah, so that's all about X's loan account. So X's account should not be prepared again while we are preparing capital account. Now what we are going to do, we have to do something here regarding this 64,000. That is, we have already paid the interest amount, right? So they have told us in the question that 31st December 2013 they are going to get profit of 64,000. Okay, fine. So we are going to prepare, in the question they have asked us to prepare a profit and loss appropriation account for the year ended 31st 12/2013. We are going to prepare a profit and loss appropriation. They have told us to prepare a profit and loss appropriation account for 31st 12/2013. As we all know, profit and loss appropriation account is an account where we show the distribution of reserves, funds, and profit, losses, everything. Okay, so in this case 64,000 have to be shared among the partners, and it is going to be shown in this account. But there is a problem. When we are preparing a profit and loss account, what actually affects the profit? So this 64,000 is a profit. So what affects the 64,000? Interest amount will be affected, because we used to write the interest on loan on profit and loss account, right? So that would affect the profit amount. So we are going to subtract the 6,400 which we got as interest, 6,400. But the study mat, they have written as like this, 16,000 they are writing as loan redemption fund. I'm not really getting the logic here. So if any one of you knows the perfect explanation regarding this, you can please comment it down. That would help me. Okay, so what I am going to do is I am going to prepare profit and loss appropriation account in this manner. So we are considering the 64,000, fine, but the 64,000 will be affected because of the interest 6,400 which we are going to pay. So the 6,400 have to be subtracted from the 64,000, and the rest have to be shared among the partners. 57,600 is what the profit we will get from this, and this have to be transferred to Y, Z and R. They are the partners, include existing partners plus the newcomer is there. R is a newcomer. So 1:1:1 is the profit sharing ratio. So 90,200 each one will get. Fine. And this sentence, nothing but I just wrote it down. Repayment of loan is 25% of profit before interest, that is 64,000 into 25% is equal to 16,000, paid together with the interest accrued for the year 6,400. Now we are going to prepare our capital account. Now we are going to prepare the capital account, which the question have asked us to do. Okay, so the balance brought down, this have to be transferred from the first capital account which we draw, 96,000 and 86,000. Okay, so 96,000, 86,000, Y and Z. Then comes what? By bank. R is going to bring capital 1 lakh, right? Then now we are going to write the share of profit which we got from the profit and loss appropriation account, 19,200. Okay, that have to be written here, nothing else. Total, and you'll get the same here itself, and that will be also written as closing balances. So these are the closing balances. If you're going to take as I did, that is interest on 6,400, but in study mat they have did in otherwise. Study mat they have followed another method. I'm not sure about it. Okay, so if any of you knows what is actually the logic or the concept between what the study mat have written, please do let me know. Okay, please comment it down, so it might help many. So exams are very near to us. I'm sorry that this video was late, that I got the almost correct explanation, even though I'm not telling it is the 100% correct explanation of illustration number 23. Okay, now the other doubt that most of you might ask me is that I have told you that retiring partner have to be given his portion of goodwill, but that have to be given by existing partner. So there was lots of people, lots of students, lots of friends ask me this doubt. So I think the concept is like this: if you are going to raise the goodwill, or if you are going to raise, or if you are going to write off the goodwill, in either of these cases, I think in those cases we will be not will be not showing as existing partners are going to give the retiring partner the portion of goodwill. Fine, the first point. And the other point is, we all know that newly admitted partner have to bring a portion of goodwill, right? But in this question they are not bringing. So I think it is because I have already told you that to prepare I told you to do the sacrifice and gaining ratio calculation, right? That is because you will get to see the existing partners, that is Y, Z and R having gaining ratio. Okay, that is Z and R, Y and Z, whose existing partners are having gaining. Okay, they are getting the gaining ratio. So usually when a new partner brings the goodwill premium, that will be shared among the partners in their sacrifice ratio. So there is no sacrifice in case here, in this case, in this scenario, there is no sacrifice for Y and Z. So I think that is the reason why the new partner is not bringing the goodwill in this question, or they are not showing anything regarding that. Okay, so this is all about illustration number 23, I guess. Okay, now let's start discuss illustration number 24. This is the last question that comes under the head admission cum retirement. Here two partners are there, Geeta and Meeta, and they are equal partners. So obviously their profit sharing ratio is going to be 1:1, and Geeta is going to retire, and a new partner called Leda is going to join, and her share is 1/3. Okay, she's going and this all are happening on 1st April 2030. The balances are given. They have not given us a balance sheet, instead they have given us the balances of the books. And after that, let's read the question further. Goodwill and fixed asset valued at rupees 30,000, 1,40,000. So here when you see, goodwill is going to be valued at 30,000. So this is going to be the current value of the goodwill. But in the balances they have given us, they have already showed goodwill that 10,000. So we have to bring this 10,000 to this 30,000. So the difference 20,000 have to be raised, right? Sorry for the disturbance. Okay. So 20,000 have to be raised. Then comes what? Fixed asset at cost. So fixed asset cost is given as 1,20,000, and this is going to be valued at 1,40,000. That means 20,000 is going to increase. So this 20,000 have to be shown in the revaluation account. That's it, respectively. And it was agreed to be write off provision for depreciation. You have to write it up here. They have they have missed that portion. So we have to write off provision for depreciation. That is what they are trying to convey here. So here provision for depreciation is that 12,000. We have to write this off, so we can use revaluation account. Okay, we can write like liability is being decreased. We can write it like decrease of liability, which is this provision for depreciation is a liability. Okay, so provision for depreciation can be reduced with the help of revaluation account. Okay, so we're going to write it off with the help of revaluation account accordingly before admission of Leda's partner. Now sufficient money have to be introduced so as to enable Geeta to be paid off. Yeah, so Geeta is the one is going to retire from the firm, and as usual we all know, retiring partner have to get all portions or all amount which is due to him. And also what happens, so as to enable Geeta to be paid off and leave rupees 5,000 cash at bank. So similar kind of question, similar kind of point appeared in another question to. So what we did there, we prepared a bank account and we made this particular amount as a closing balance. Okay, so same we are going to do here. So this 5,000 is going to be the closing balance. Then Meeta and Lata are to be provide such sum as to make their capitals proportionate to their share of profit. Okay, so certain sum have to be bought in and certain sum have to be withdrawn by Meeta and Lata so that they can make their capitals in proportionate to the share of new profit sharing ratio. Assuming the agreement was carried out, show the journal entries required and prepare the balance sheet after admission of Lata. Okay, so here they have already given us Lata's portion, that is 1/3. So we can easily calculate the new profit sharing ratio between Meeta and Lata. Okay. So let's just first prepare the revaluation account for this question. So we have already told that we are going to raise the goodwill, and we are going to raise the goodwill by using revaluation account. So we are going to write the goodwill 20,000 here. How did 20,000 we came? That in the books they have given us 10,000. 10,000 is the value of goodwill which they have shown in the books, but the current value of goodwill is 30,000. So the difference we are going to raise. So 20,000. So in new balance sheet, what is going to appear? 30,000 will appear. Fine, because we have already raised the balance 20,000 also. Now the goodwill value will be 30,000 in the new balance sheet. Now fixed asset, they have told that fixed asset is going to be increased by 20,000. It was 1,20,000 and it is going to be 1,40,000 now. So the difference is 20,000, that is going to be increased now. And the next thing is going to happen is we are going to write off the provision for depreciation. They have asked us to write off the provision for depreciation. Write off the provision for depreciation. It is being reduced 12,000. Then comes what? Nothing comes. So credit side is the only side which amount is going to appear in revaluation account. So we are going to write the exact same total here itself, here also. So this again comes as a profit. Now this is going to be shared among the old partners, that is Geeta and Meeta, in their profit sharing ratio. So revaluation account is okay, I guess. When you read this question, they have not given us the amount which has been introduced to the firm, and also neither they have also given us the closing balances of capital. So what we are going to do? They have not asked us to do adjusted capital method. They have not asked us to do anything like that. So what we have to do is that we all know what is the capital. Asset minus liability is what we call as capital, right? Asset minus liability is what we call as capital. So we are going to take the all adjustments which you have told us to make. So we have made the goodwill value 30,000. So take that 30,000 here. Fixed asset we are going to consider 1,40,000. That is a raised value. That is increased value, which is that is a current value fixed asset. So 1,00,000. That is a current value fixed asset. So 1,40,000. Then stock doesn't change, right? So stock as well as debtors doesn't change. And they have also told us when it comes to stock, debtors will be writing as it is, and when it comes to cash at bank, they have told us to leave 5,000 rupees at the back. So 5,000 is going to return right here. Fine. Then creditors doesn't change, right? Creditors is going to be 40,000. No, 20,000 itself. Okay, creditors is 20,000. So creditor is going to be 20,000. So we're going to subtract the liability from it, because we all know asset minus liability is what we call as capital. And in this question, they have not given us any hint about what we have to do. So we are going to do it in this way. So we got 2,55,000 is the capital of the firm. Now we know the only two partners now existing in the firm is Meeta and the new admitted partner Lata. Geeta have already retired, right? So this 2,55,000 have to be shared among Meeta and Lata in their profit sharing ratio. So for that you have to first find the new profit sharing ratio. So I'm leaving that to you. I'm not going to show you the calculation of new profit sharing ratio. You might be already knowing how to do it since we have come this far. Okay, so after doing their calculation, we will get 1,70,000 as Meeta's capital, and Lata's capital is going to be 85,000. This is what are these? This is going to be the closing balances. Okay, so we got the closing balances. Now we can easily find the introduced amount. What is the amount that is being introduced? What is the amount which have been withdrawn? We can easily find it as the balance in figure, because we will get that as the balance in figure if you are going to draw the capital account now, because we already got what is the closing balances. Okay. So in this question, they are not actually preparing the capital account because they have not asked us to prepare. They they have prepared a kind of statement where we are going to find the amount which should be bought in by Meeta, so that she could make it equal to the she could make her balance equal to the new profit sharing ratio. So here see, capital to be maintained is 1,70,000. This is the amount which we should get. That is closing balance. We have to get 1,70,000. Fine. Opening balance now she have is what? 1,02,000. It is given here. So 1,02,000 is what she have now, and profit on revaluation she got, right? Profit on revaluation. This is just like how we are preparing a capital account only. Okay, it's just that they have shown it in another way. This is just like a capital account. If you're going to prepare Mita's capital account, this will be the same answer we are going to get. This 1,70,000 have to be written as closing balance, 1,02,000 as the opening balance, 26,000 we have to share Mita's share of profit of revaluation, right? We have got the revaluation profit. We have already prepared revaluation account, so we have to share the profit with Mita. And what happens after doing all this? We'll get a particular amount as balancing figure, and that balancing figure will be the amount which have to be bought in by Mita. If you are going to prepare in a capital account wise, then if that amount is going to appear in the debit side, then that amount should be withdrawn. But if the amount is going to be appeared on the credit side of the capital account, that means that amount have to be bought into the firm as a capital. So 42,000 have to be bought in by Mita. Okay. Now what we are going to prepare is bank account, because they have already told us to keep 5,000 as they have already told us to keep 5,000 in the bank. Rest you can do whatever. So the first thing 8,000. They have already asked us to keep 5,000 as a closing balance. They have already asked us to keep 5,000 in the bank. So what we are going to do is that we already have bank account as 8,000. When you see here, cash at bank will be 8,000. Right? Yeah, 8,000 is bank balance. So we are going to write it as the opening balance 8,000. Okay. Then comes Geeta's capital and the amount which the firm have to give Geeta. What is that? 1,30,000. How did we get 1,30,000? Let's see. Here in the question they have given us Geeta's opening capital is 1,04,000. So take 1,04,000. Okay. Take 1,04,000 plus the profit of revaluation. Revaluation profit we have to consider plus 26,000. We get 1,30,000. This amount should be given to Geeta by the firm. Okay. So that amount we are going to less that amount 1,30,000, and they have also asked us to keep 5,000 in the bank. So we are going to write it as a closing balance. So the balancing figure is 1,27,000. In this 1,27,000, we go to know 42,000 have to be bought in by Mita. So what is the balance amount? Balance amount will be 85,000. So most probably it is the amount which Lata have to bring in as capital. Okay, so that is the assumption. That is, after preparing the bank account, we'll get 1,27,000 as the balancing figure. In this 1,27,000, we already go to know 42,000 have to be bought in by Mita. And the balancing figure, that is 1,27,000 minus 42,000, that is 85,000 we'll get. We are assuming that is the amount which is Lata is going to bring into the firm as capital. Fine. So this is how we do the bank account. Fine. Okay. Now we are going to journal entries. Now the first thing we are going to do is goodwill. We have raised the goodwill with the help of revaluation, right? So goodwill account debit 20,000. Goodwill is an asset, right? So when asset is increased, we have to debit it. Fixed asset is also increased 20,000, and provision for depreciation we are going to write off. Okay, and that is also going to be written here 12,000. So everything we are going to do with the help of revaluation, right? So we have to write to revaluation, and the same thing which we done in revaluation account have to be written as a journal entry. Next comes what? We are going to share the revaluation profit with the partners Geeta and Mita in their profit sharing ratio. Then comes what? Amount, right? The bank account have to be, the firm have to give particular amount to Geeta, who is a retiring partner. We have already found that amount, that is 1,30,000. How did we get this amount? We know the opening balance of Geeta is 1,04,000, and we go to know the revaluation profit of Geeta is 26,000. When we add both together, we got 1,30,000, and that have to be given by the firm to Geeta, as she is the retiring partner. Next comes what? The additional cash which have to be bought into the firm by Mita and Lata, that is also have to be shown in journal entry. So bank account debit to Mita's capital account to Lata's capital account 1,27,000, 42,000, 85,000. The same thing which we done here. Okay, so these are the 4 journal entries which the study mat have provided. Next we are going to prepare the balance sheet. Is easier because we have already considered all these things in order to find the capital, right? So goodwill we have to take 30,000, fixed asset 1,40,000. After all the changes, we have to take the asset and liabilities which have arrived after all the changes. We are considering all the changes. Here goodwill is going to be 30,000, fixed asset is going to be 1,40,000, stock is going to be 60,000. There is no provision of depreciation appear in the balance sheet because we have already written it off. Next come debtors 40,000, there is no change in it. Cash at bank will appear as 5,000 because we have only kept 5,000. They have only asked us to keep 5,000 in the bank, so we have kept 5,000. So that is the only amount which we are going to show here. Next comes what? we have to show the capital Mita and Lata, which we have already found. So 1,70,000, 85,000. Next come creditor. There is no change in case of creditor. So we are writing 20,000 as it is. Next, when we add both the sides, we'll get 2,75,000. Okay. Illustration number 24 is easy question, I think. When it compares to 23 and 22, it is a bit easier than them. So I think whatever I explained in the video is clear for you. If you're having any doubts, you can comment down. Even I'm studying, I'm learning with you, so even I get confused in between. Okay, so thank you for watching and work your studies.